Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. We continue to revise past papers, company accounts, past paper CPA 1, financial accounting, company accounts, simply because of the demand we're getting from our students. And I want to repeat again, kindly support us. The only thing I need from you is kindly support us, subscribe, share, like, and hit the notification bell so that every time we load this kind of videos, we are able to inform you and you'll be able to benefit from them. We are also doing online classes. We have done that for the last 16 years. We've been training accountants for the last 16 years, and I can assure you, you will be training with the best. So today, I want us to solve a question that is November 2019, question 3B. November 2019, question 3B. November 2019, question 3B. So we want us to do CPA 1, FA, November 2019, question 3B. Question 3B. And we start with the workings. We start with the what? Every time as you prepare your income statement, as you prepare your balance sheet, always have in mind, ask yourself, did my workings affect any item? At times students spend a lot of time doing workings. You do the workings, all of them very well, but when you go to lifting the information, you just concentrate from the trial balance. You must always ask yourself, before you go into the trial balance, ask yourself, are the items in the trial balance adjusted through our workings? Are the items in the trial balance, be they sales, purchases, expenses, current liabilities, non-current liabilities, shareholders' funds, were they affected? Before fixing them anywhere, in the income statement of the balance sheet, ensure that you ask yourself if they were adjusted by our workings. It is easier to do the workings and do the adjustments if you're not going to lift the adjusted figures and take them to your financial statements. You will still not be given marks. So it's very important to take care of your workings. So we are told in this particular question, the following balances were extracted from the books of Mesa Limited on 30th of June 2019. Authorized and issued share capital. Ordinary shares of shillings 5 per value, 150,000, 10% preference shares of shillings 10 per value, 60,000. Inventory as at 30th of June. That is giving you the opening inventory. Yes, 30th of June 2019, and our year is ending on 30th of June 2019. And therefore, there you are being given the closing inventory. You must be careful with dates. Be careful with the dates in accounting. When I told inventory is the 30th of June 2019, and you are preparing the financial statement as the 30th of June 2019, it means you are being given the closing inventory. Accounts receivable and prepayments, accounts payable and accruals, bank balance, 12% debentures, general reserves, bad debts, gross profit for the year. This is one of the tricks in this particular question. I gave this question to our students, and some of them still wanted to look for sales, less return inwards, less return inwards, get net sales, less cost of goods sold, opening stock, add purchases, cost of goods available for sale, less closing stock, cost of goods sold, subtract from sales to get gross. He has done that for you. You don't do what has been done. And you've not been given that information. So you don't need to, you don't have to start where ordinarily we start. You start where the question tells you. This one tells you have been given a gross profit, so you just continue from gross profit. And that's why the marks are fairly few. But that was the biggest trick in this question. Then we are told wages and salaries, insurance and rates, telephone expenses, electricity and water, debenture interest. Debenture interest, I said, always be careful, be sensitive. Compute the debenture in card, and then you find out, have we paid everything? Have we paid everything? Debenture interest, director's fees, general expenses, motor vehicle. Another trick there. You are being given the net book value. You are being given the net book value, and therefore the difference between the net book value and the cost gives you the accumulated depreciation up to the beginning of the year. The same thing with office furniture and equipment. Land and buildings at cost, profit and loss at the beginning of the year. That's retained earnings. Depreciation is to be provided as follows: motor vehicle 20% per annum on cost, office furniture 15% per annum on cost. As of 30th of June 2019, an amount of 822,000 for electricity consumed has not been paid, so it's a current liability. The insurance expense amount on 30th of June 2019 includes an amount of 450 paid in June 2019 for the period of 1st of July 2019 to 30th of September 2019. Provisions, director's fee, audit fees. The directors recommend the following: 18,000 to be transferred to the general reserve, preference share dividend be paid, and 10% ordinary shares be paid. So let's quickly do our adjustments. And I always like saying in company accounts, the first adjustment you always need to do is debenture interest. Debenture interest. Debenture what?
Interest.
Debenture interest. We are told we have a 12% debenture, 12% debenture, and the debenture amount is 24,000. 24,000. 12% of 24,000. 12% of 24,000. 0.12. Even if you are not told, 0.12 of 24, 1, 2, 3, you are told it is 28.80. Our debenture interest is 28.80. It is 28.80. And then we are told debenture interest paid is 1440. Less paid. 1440. This 28.80 is our expense. 28.80 is our expense. 1440 minus 1440. So 1440 is the debenture interest payable. This is the interest payable. This is the interest what? Payable. This is the interest payable. Then let's go to the workings. Depreciation. Depreciation expense. Motor vehicle. This is straightforward because it is on cost. And office furniture. Furniture and equipment, 15%. We are told it is 15%, and motor vehicles it is 20%. So we go to the trial balance and get the costs, the purchase costs for the motor vehicles. For the motor vehicle, please mark, don't go to the net book value. Go to the cost given, 59,100. The trial balance shows a figure of the net book value, but you are told clearly it is 59,100. The original purchase cost is 59,100 times 59,100.2. 0.2, we get a figure of 11,820. 0.2 of 59,100, we get a figure of 11,820. 11,820. 11,820. Then furniture and fittings is 36,960. That is 6,960. 15% of 36,960, which is equal to 0.15 of that is 6,960. We get 55.44. We get 55 what? 44. We get 55.44. Then you are told, as of 30th of June 2019, an amount of 822,000 for electricity has not been paid. So our electricity and water, how much have we paid of electricity and water? How much have we paid of electricity and water? We had paid electricity and water amounting to 1824. 1824. balance per TB. And then we are told we have incurred, but we have not paid 822. We have incurred and we have not paid 22, and therefore electricity and water payable. Electricity and water what? Payable. Payable. You don't have to put all those accounts there, but you need to capture it so that when you are checking where to the payables, you'll be able to get it. 1824. 1824 plus 822. 822. It has been incurred, but it has not been paid. It has been incurred, but it has not been paid. 2646. 2646. 2646. So we take to the P&L. We take to P&L account 2646. You take to the P&L 2646. And then we are told the insurance expense amount for that amount on 30th June 2019, the insurance we have indicated there. The insurance we have indicated there. We are calling it insurance and rates. Insurance and what?
Rates. And
rates account. The balance, palletary balance, the balance brought down, insurance and rates is 2115. It's 2115. Then you are told this amount includes an amount of 450,000 paid in June. Remember, our year ends on 30th of June. Our year ends when? Our year ends on 30th of June 2019. Our year ends on 30th of June 2019. And you are told that it was paid in June, but it's for this period, for the period between 1st of July, it is for this period. It is not for this period. It is not for our current period. Our 1st of July 2018, that is the current accounting, the period we are accounting for. But we are told we paid here at the end of the year, but we are not paying for our period. We are paying for the following period. And therefore, this amount is prepaid. Is prepaid insurance. So we carry it down. It's not an expense. So we carry it down as a current asset. We carry it down as a current asset amounting to 450. We carry it down as a current asset amounting to 450. 2115 minus 450. 2115 minus 450. 2115 minus 450. We get a figure of 1665. So what we take as an expense to the income statement is 1665. 450 is a current asset. It's a prepaid insurance that we are taking to the balance sheet. It's a prepaid insurance that we are taking where?
Balance sheet. To
the balance sheet. It's a current asset called prepaid insurance that we take to the balance sheet. Then you are told provisions are made for the following. Director's fee. Anytime we are talking about provision, you must know that we are saying that we have incurred, but we have not paid. We have incurred, but we have not paid. And therefore, it's an expense in the income statement, but also a liability as a current liability in the balance sheet. Therefore, director's fees account. Look at the trial balance. Do we have director's fees? Yes. We have director's fees amounting to 3750. 3750. But we are told that is the balance. But we are told we have director's fees incurred but not paid, amounting to 7,500. And therefore, we have an expense called what? Director's fees payable. We have a liability called director's fees payable. We have a liability called director's fees payable as a current liability. We need to take it to the current liabilities in our balance sheet. We need to take it as a current liability to our balance sheet. So we added to 3715 plus 7,500. We get a figure of 11,250. 11,250, and that is what we take to P&L. We take to P&L 11,250 as an expense, as director's fees expense. As director's fees what? Expense. Then we have audit fees. We have audit fees. We do the same with audit fees. Account is an expense account. Check whether we have audit fees in the trial balance, and we don't seem to have audit fees. in the trial balance, and therefore we just say audit fees payable. The expenses is the debit and the credit is audit fees payable, and we are told it's about 7,200. 7,200. So we have audit fees payable. Audit fees payable amounting to what? 7,200. 7,200. Then you are told the directors recommend again. When it is a recommendation, it is something that will be done in the future. It is not done now. It will be done in the future. Therefore, if it's an expense, we debit the income statement and we credit the current liability account, the respective current liability account. Transfer to general reserve. Transfer to general reserve an amount of 18,000. Preference dividend to be paid. Preference dividend to be what? To be paid. So we want to ask ourselves, did we pay any preference dividend? Did you pay any preference dividends? We don't seem to have paid any preference, any dividend. We don't seem to have paid any dividends, And therefore, preference dividend to be paid, and our rate for preference dividend is 10%, and the total preference, the rate for our preference share capital, it is 10%, 60,000. Preference dividend, it is 10% of 60,000, which is 6,000. It is 10% of 60,000, which is 6 what? It is 6,000. Then we are told 10% ordinary share dividend to be paid. You must remember, it is also it's payable. It is also preference dividend payable. It's also preference dividend what? Payable. Dividend payable. It's both an expense and a liability. 6,000. It's an expense and a what? Liability. Always like payable so that you're able to remember to take it to the current liability among the current liabilities. Then we are told ordinary dividends will be 10%. Ordinary dividend will be 10%. Ordinary dividend expenses, dividends, payable. I like saying payable so that you always remember it's a current liability. It is 10%, and the ordinary share capital is 150,000, and therefore it is 15,000. The ordinary dividend is 15,000, and those are the workings. So quickly we do the income statement and the balance sheet. We are told to do the income statement and appropriation account. So if we would start the income statement from there, we would say Mesa Limited, income statement. We said income statement for the year ended 30th of June 2019. Now, we say we start where we have been given the information to start. So we start with our gross profit. Always remember the format. Shillings in thousands. 122,262. 122,262. We ask yourself, do we have any incomes? Do we have any incomes such as interest income, but we do not have I walk through the trial balance, does not show any other income. So we say less expenses. So we say less what? Expenses. And like I say, you first of all start with the adjusted expenses. What? Expenses. Debenture interest 2880. Debenture interest. It is 2880. 2880. Interest payable, depreciation, motor vehicle. Depreciation, motor vehicle. 11,820. Furniture 5544. Furniture and equipment 5544. electricity and water. $26.46. Electricity and water $26.46. Insurance $16.65. Insurance and rates $16.65. Directors' fees $11.250. Yes, and all of them we know they are payable. Transfer to general delivery. So those are the expenses that required adjustments. Those are expenses that required what? Adjustments. So we now go back to a trial balance and we look for the expenses that did not require any form of adjustments. Authorized share capital, preference share, accounts receivable, accounts payable, bank balance, general reserve, bad debts. Bad debts amounting to 510. Bad debts amounting to 510. Bad debts amounting to 510. Gross profit, wages and salaries amounting to 42,300. Wages and salaries 42,300. Insurance and rates. We have captured insurance and rates. Telephone expenses amounting to 930. Electricity and water is there. Debenture interest is there. Directors' fees are there. General expenses 4662. General expenses 4662. 4662. Motor vehicles, that's the cost of, those are the expenses. Those are the total expenses. So if we now add all our expenses together, we add them together, 2880 plus 11,820 plus 5544 plus 2646 plus 1665 plus 11,250 plus 510 plus 42,300 plus 930 plus 4662. We get a figure there is something we are missing. There's something we are missing here. We're definitely missing audit fee. We are missing audit fee. You're missing audit fee. So we add audit fees. We add audit fees here, 7,200. 7,200. Let's try to add them up now. 2880 plus 11,820 plus 5544 plus 2646 plus 1665 plus 11,250 plus 510 plus 42,300 plus 930 plus 4662 plus 7,200, we get a figure of 91,407. We get a figure of 91,407, and that is total expenses. Total expenses. We subtract from the gross profit minus 122,262. We get a figure of 38,55. We get a figure of 38,55, and we call it profit before tax. Profit before what? Tax. 38,55. So we less income what? tax expense. We less income tax expense, and we say that our income tax, if we look at our question, have we been given the tax? Have we been given the tax for the year? We have not been given tax. You have not been given tax. You cannot fake. You cannot fake what you have not been given. You cannot fake what you have not been given. We have not been given income tax expense. Ordinarily, that's the format. That's the format. But you have not been given the income tax expense, and therefore we say transfer to general reserve. Transfer to general reserve. We said within our workings that we are transferring to general reserve of 18,000. We are transferring to general reserve an amount equivalent to 18,000. So we remove 18,000 there. That 855. That 855 minus 18,123. We get a figure of 12,855. We get 12,855. It is profit after transfer to what? To general reserve. Then we say dividends. We say what?
Dividends.
We say dividends. And always remember that dividend can be both, it can be both interim and final. But in our case, our dividend, we don't have any dividend which has been paid on an interim basis. We have dividends which is payable. So we talk about preference dividend of 6,000. Here it is. Preference dividends. 6,000. Ordinary dividend of how much? Ordinary dividends here of 15,000. Ordinary dividend of 15,000, giving us a total figure of 21,000. And you can see now it is giving you a total figure of 21,000 when the ordinary money we have it is 12,855. It is 12,855. Now, when this happens, the profit we have is 12,855, but we need to pay dividends amounting to 21,000. The dividend we want to pay is much more than the profit we have. So we need to transfer the retained earnings and bring it to the retained earnings at the beginning of the year. We bring it so that we can increase the retained earnings. You must know the difference between revenue reserves or retained earnings and the general reserve. So we got to the profit and loss account at the last item in the trial balance. So we add profit and loss account. Profit and loss account. That is the retained earnings at the beginning of the year. That is 6,378. That is 6,378. This was meant to confuse you when you talk about you are transferring to general reserve. General reserve and the retained earnings are different. We are transferring to general reserve, but we are bringing the retained earnings at the beginning of the year to help us pay our dividends. To help us pay our what? Dividends. Our dividends. So we add 12,855. We add 12,855. 12,855 plus that is 6,378. That is 6,378. We get a figure of 49,233. We get a figure of 49,233. 49,233. And we're saying profit after retained earnings brought down. As they are brought down, we have added a profit retained earnings brought down. So we say dividends. We say what? Dividends. We are now able to pay dividends. We are now able to pay out 1,000 dividends. Ordinary dividend, preference dividend. Always start with the preference. Don't start with any. Always start with the preference dividend. That proves you that you are a good accountant. Preference dividend worth 6,000 and ordinary. And ordinary dividends worth 15,000. Giving us total dividends amounting to 21,000, giving us 30. So we subtract from 49,233, 49,233 minus 21,000, we get a figure of 28,233, 28,233, 28,233, and this is the retained earnings carried down. This is the retained earnings, or P&L. It is also called the profit and loss account. The profit and loss account, retained earnings carried down. That is what we carry to the balance sheet. From this income statement, that is the only figure that you carry to the balance sheet. And like we have always done, we will put it here. We will put it here. We will capture it here. 28,233, 28,233 as our retained earnings carried down. As our retained earnings carried down, so that we can erase and do the balance sheet on the far end. We can erase here and we do the balance sheet here. You can do the balance sheet here for Meza Limited. You can do the balance sheet here for Meza what?
Limited.
Meza Limited. Meza Limited. Meza Limited. And we are saying that Meza Limited had Meza Limited statement of financial position. Statement of financial position as at 30th of June 2019. 30th of June 20 what? 19. We start by saying assets, then we say what? Non-current assets. Non-current assets. And you know we say we have cost, we have provision for depreciation, and we have net book value. Net book what? Net book value. And therefore, we look at our assets and remember that our assets are recorded based on they are all recorded based on permanence. So we start with land and buildings. We start with land and buildings. That's the most permanent. The cost of land and building is 198,060. 198,060. 198,060. This is shillings in thousands. Shillings in thousands. Shillings in what?
Thousands.
198,060. 198,060. And we do not have furniture and equipment, office furniture and equipment. Furniture and equipment. And we know that the original cost of office furniture and equipment is at 6,960. That is 6,960. Please mark that. You have been given the cost and the net book value. You have been given the cost and the net book what? Yeah. You have been given the cost as that 6,960 and the net book value at the beginning of the year was 11,160. So you subtract the two to get the accumulated depreciation at the beginning of the year. That in 6,960, that is 6,960 minus 11,160. You get the accumulated depreciation was 25,800. It was 25,800 at the beginning of the year. That was the accumulated depreciation, and therefore, and we have. I want to repeat again. The net book value was 11,160. 11,160 minus that is 6,960. That is 6,960. We get a figure of 25,800. But we have a charge for the year. Furniture and we have a charge for the year. Depreciation. Yes, our depreciation for furniture and fittings for the year is 55,44. You add 55,44. 55,44. We get a figure of 31,344. 31,344. So furniture and equipment, the charge is 31,344. 31,344. That is 6,960. That is 6,960. We get a figure of 5616 as the net book value. As the net book value, 5616 as the net book value. We do the same for motor vehicles. We do the same for motor vehicles. We do the same for motor vehicles. We are told that they were bought at 59,100. 59,100. But at the end of the year, after the end of last year, the net book value was 59,100. 59,100 minus 5,900 minus 4,200. 4,200. So we have a balance of 18,900. So the depreciation again was 18,900. The depreciation at the beginning of the year. The depreciation at the beginning of the year was 18,900. We add the charge for motor vehicle for the year. This is the charge for motor vehicle for the year 11,820. 11,820. So we add here 11,820 to get the total depreciation. 11,820, 18,900 plus 11,820. 11,820. We get a figure of 3720. We get a figure of 3720. 3720. We are through with this. We can now erase them. We are through with this. We can erase them. We are through with this. We can erase them. So 59,100. 59,100 minus accumulated depreciation as of the balance sheet date. 3720. 3720. We get a figure of 28,380. We get a figure of 28,380. 28,380. 28,380. If you add all of them, plus 5616, plus 5616, plus 198,060, 198,060, we get a figure of 232,056. A figure of 232,056. A figure of 232,056. 050 what? 232,056. Always ask yourself, do we have investments? This is PPE. Do we have investments? Fortunately, our question does not have investments. So we come here and we say total non-current assets. Total non-current what? Assets. Then we come to current what? We come to current assets. We come to current assets, and we know we always start with inventory. Current assets will always start with inventory, and we were given in the trial balance. The inventory we were given in trial balance is not the opening inventory. It was the closing inventory of 95,775. Close opening inventory of 95,778. 95,778. 95,778. Then we talk about accounts receivable. We talk about accounts receivable. That's the order. That's the order. The memorized formula. The memorized formula. Our accounts receivable, we said it is, our accounts receivable is 2583. 2583. Our accounts receivable, Our accounts receivable from the trial balance, it is 4,800. It is 4,800. It is 4,800. From there, we talk about prepayments. We talk about what? We talk about prepayments, and we are saying insurance and rates. We are prepaid of 450. Prepaid insurance 450. Prepaid insurance. Insurance 450. Remember our formula. Remember our formula. So you ask yourself, do we have short-term investments? Do we have short-term investments? Don't have them. Do we have cash in bank? At least you have a bank balance from the trial balance amounting to 11,694. A bank balance amounting to 11,694. A bank balance amounting to 11,694. So we add them up. We add them up. 11,694. 11,694 plus 450 plus 4,800. 4,800 plus 95,778. 95,778. Get a figure of 148,722. 148,7 what? 148,722. That becomes total current assets. Total current assets. You add total current assets to non-current assets to get total assets. To get total assets. So you add to the non-current asset. You add it to the total non-current assets. 232,056 plus 232,056. We get a figure of 380,770. We get 380,778. 380,778. 380,778. Those are the assets. Where did we get the sources of funds? We say financed by. We say financed by, and we have ordinary share capital. We have ordinary share capital. We have ordinary share capital. Sorry, we say financed by equity, and what? And liabilities. Equity and liabilities. And then we say equity and reserves. Equity and reserves. The formula you find me use, those who are doing CPA, the format you find me use, that is what you're supposed to use even when we are doing financial reporting. When we are doing published accounts in financial reporting, we use the same formulas. And therefore we say ordinary share capital. Ordinary share capital. If I teach you financial accounting, you will enjoy doing some papers in financial reporting because you have already covered quite a bit. So ordinary share capital is 150,000. 150,000. Preference share capital. Preference share capital. Preference share capital. Preference share capital is 60,000. 60,000. Preference share capital 60,000. Then we get to general reserves. We get to general reserves. We say it is 42 plus 8. General reserve. So we add general reserve. We get general reserve. And if you look at the trial balance, we have general reserves amounting to 42,000. We have general reserves amounting to 42,000. And we transferred to general reserve. Transfer to general reserve amounting to 18,000. Transfer to general reserves amounting to 18,000. 42,000 plus 18,000. We get 60,000. We get 60,000 of general reserves. We get 60,000 of general reserve. Then we get the retained earnings. We get our retained earnings, and we say that the figure is here. We say the figure is here. We say retained earnings. Retained earnings or profit and loss account 28,233. 28,233. That becomes our total shareholders funds. That becomes our total shareholders funds amounting to 150. 150 plus 120 plus 28.233. 28.233, giving us a figure of 298,233. Giving us a figure of 298,233. 298,233. Total shareholders funds. Total shareholders what? The shareholders funds. Then we come to non-current liabilities. The format. Non-current liabilities. And we said we have debentures, 12% debenture amounting to 24,000. From the trial balance, 12% debenture, which amounts to 24 what? 24,000. Then we talk about current liabilities. The format I'm giving is the one that we use in section 3 to to do financial reporting. When you are doing financial reporting, we use the same when you are doing financial reporting, a subject called published accounts. A subject called published accounts. So our current liabilities always start with accounts payables. Accounts payables, from the trial balance, we have an accounts payable amounting to, from the trial balance amounting to 2583. 2583, accounts payable amounting to 2583. Remember the format. Ideally, if we had bank overdraft, we would start with bank overdraft, then we come to accounts payable. We would start with bank overdraft, then we come to the accounts payable. Then quickly go through your workings. Picking all the accounts payables which have been created. The first one is interest payable, 1440. Interest payable, 1440. 1440. Then we have electricity and water payable, 822. Electricity and water payable, 822. Insurance, director's fees payable, 7,500. Director's fees payable, 7,500. 7,500. Then we have audit fees payable, 7,200. We can actually delete the whole of this to continue with our balance sheet here. We can delete this one so we can continue our balance sheet here. We can continue with it here. So, audit fees payable, 7,200. Audit fees payable. Amounting to 7,200. Preference dividends payable. Amounting to 6,000. Ordinary dividends payable. Amounting to 15,000. So we check whether there is anything on the trial balance that we have not captured. Whether there is anything that was not being adjusted but has not been captured, or I'm not seeing anything. So we quickly add them up to find out what the balance is. 2583 plus 1440 plus 822 plus 7,500 plus 7,200 plus 6,123 plus 15,123. We get a figure of 58,545. As total current liabilities. Total current liabilities. And if we are really helping you, please help us also. Subscribe, share, like, hit the notification bell so that when this kind of videos come, you are able to benefit even as you support us. So our total current liabilities is 58,545. If we now add the total non-current liabilities and the shareholders' funds, we will check whether they agree with the total assets. So we add total non-current liabilities, 24,123, plus 298 to 33, 298 to 33, we get a figure of 387.78, and it is getting to the same figure with the total assets, 387.78. So this is equity, total equity and liabilities. Total equity and what? Liabilities. We have done quite a number of questions. We have done quite a number of questions on company accounts. And the objective was not just to do the questions on company accounts, but to give the different perspectives of the examiner's tricks and techniques that make students fail in this question. You are most guaranteed in any CP1 financial accounting paper, chances of missing a company account is almost zero. And there is a lot of cry from our accounting students that we do a number of them. And that's why we are doing a number of them, because we are here to help you pass your exams. We are here to help you pass your exams. And therefore, if you go through all our questions, which are very clearly captured in our channel, that they are CPA FA questions, you will be able to get the different traps that the examiner uses to test our students. In this particular case, you realize that the examiner, number one, gave gross profit instead of giving the whole income statement, instead of giving sales and everything, the cost of goods sold and everything. And many students get stuck there and they don't know where to start. But they have been given the gross profit. Number two, you have been given the original purchase cost of the asset and the net book value. They have not given you the accumulated depreciation. You're supposed to compute the accumulated depreciation by deducting the net book value from the original purchase cost. You get the accumulated depreciation at the beginning of the year, and then you add a charge for the year to get the depreciation at the end of the year. Those were the major traps in this one, and our different questions, they are very carefully selected to answer quite a number of questions which our FA1 students have been asking. Thank you very much. I want to repeat, like, share, subscribe, and hit the notification bell. Thank you. See you in the next video.